Hey there and welcome to our channel. In today's video, we'll be discussing inflation in the US. A deep dive into the Federal Reserve's response. We're excited to share our thoughts and insights with you, so let's get started. Today we're going to take an even more in-depth look at the current state of inflation in the United States and the Federal Reserve's response to it. As many of you know, inflation has been a major concern in the US for the past few years. High inflation can be detrimental to the economy, as it erodes purchasing power, making it more difficult for consumers and businesses to afford goods and services. This can lead to slow economic growth, as well as increased volatility in financial markets. Recent data, however, suggests that inflation may be starting to ease its grip on the American economy. In November, overall prices increased by just 0.1% month-on-month, and core inflation, which strips out volatile food and energy costs, decelerated for a second consecutive month. This is good news for investors and analysts, who have grown cautious after years of high inflation rates. However, the Federal Reserve is not ready to celebrate just yet. Chairman Jerome Powell has stated that they will stay the course until the job is done. The problem is that it's not entirely clear what that means. Inflation is still uncomfortably high, and the aggressive monetary tightening of the past year is only now starting to have an impact on the economy, making it difficult to assess whether or not the Fed has done enough to rein in prices. Furthermore, the Fed's response to inflation creates a tricky balance. On one hand, they have just administered the sharpest tightening of monetary policy in 4 decades, raising interest rates from 0% in March to over 4% today. With inflation appearing to ease, it would be prudent to slow the pace of rate increases. This would help to support economic growth and avoid the risk of a recession. On the other hand, if the Fed is perceived as becoming too dovish, it could add fuel to the market rally, which in turn could lead to upward pressure on inflation. The Fed does not want to be seen as providing too much monetary stimulus, as it could lead to a further rise in inflation expectations and a loss of credibility. To resolve this conundrum, the Fed has maintained a hawkish tone while tweaking its policies. On December 14, they raised rates by 0.5 percentage point, ending a string of larger increases. Most Fed officials believe that they will raise rates to more than 5% next year and refrain from cutting rates until 2024. However, many investors believe that the Fed will end up being more dovish, and bond pricing suggests that rates will peak at less than 5% and that the central bank will start cutting them before the end of 2023. Ultimately, the decision will come down to the data. Prices of consumer goods have started falling as pandemic-era shortages melt away, and housing prices are also trending lower. The biggest concern is whether a tight labor market will push incomes and, by extension, prices higher. Investors are betting that wage increases will slow as the economy weakens. The Fed, understandably, is not ready to pop the champagne just yet. So there you have it, an even more in-depth look at the current state of inflation in the US and what the Federal Reserve's response to it means for the economy. It's important to note that inflation is a complex and multifaceted issue, and the Fed's response will be based on a variety of factors and data points. Thanks for watching our video. We hope you enjoyed it and learned something new. If you liked it, please give it a thumbs up and consider subscribing to our channel for more content like this. Don't forget to leave a comment and let us know what you thought. Until next time, take care.